Hey everyone, me Kevin here. Cathie Wood just provided some new insights into what her opinion is of the market, and I thought, hey, you know what, why not add a little bit of insight on top of her insight, because, well, it's always good to have more insight, right? And if I say insight one more time, I think we're gonna have to start a challenge where you take a shot every time I say insight. Okay, let's get into the insight. So, we're very excited, she says, about the opportunities of the last few weeks. And I have to say, of all the paper-handing sissies that exist out there, like Mr. Chom Spock, who decided to block me on Twitter, yes, thank you, Cathie, for breathing some life into the wonderful opportunities that we have presented to us. There are so many wonderful opportunities, and to keep buying at times like these actually is the reason why you can generate wonderful returns by holding through these times and investing. Cathie Wood says her goal is to return 15% compounded over the next 5 years to essentially double her money. She might end up doubling her money over the next year because she is diamond handing and buying high quality, high conviction stocks during a time when there is a lot of fear. And as Cathie Wood says, this is a gift to anyone averaging in. Very well. So what does Cathie Wood specifically recommend that we invest in? Well, of course, transformative innovation. She believes this is where we will see exponential growth. For example, in EVs, she expects EV sales to compound at 82% annually over the next 5 years, which that is almost a doubling every single year over the next 5 years is what Cathie Wood's expectation is going forward. She says, look, one of the issues that we have in the traditional investing model right now is that most analysts at maybe buy-side institutions are too reliant on old school models, too reliant on old school, let's look at the price to book ratio, let's look at the price to earnings ratio, and if it doesn't line up with our traditional measures of value, we're not interested, and we'll just go buy some AT&T stock because we'll get a nice 7% dividend over there. Cathie Wood is right. Cathie Wood realizes that a vast majority of Wall Street has no freaking clue how to value a company like Tesla, or in her opinion, a company like a Roku, or even a Square. How do you value the fact that Jack Dorsey is selling his first tweet from 2006 as an NFT, and what if this is just the door opener to Jack Dorsey who runs obviously not only Twitter and helped found Twitter, but also helped not only run Square, but helped found Square and Cash App. How do we value the fact that this could be the beginning of Cash App offering NFTs or Twitter now selling NFTs as a service? What if you integrate NFT purchasing into the freaking platform? I mean, the endless possibility of these innovative companies is the reason why Cathie Wood is investing in these, and is the reason why when times are bad and times are red and painful, Cathie Wood has essentially become groomed to say, no, these are the times to buy. In fact, that is actually how Cathie became popular in the first place. Cathie bought all of the undervalued, underappreciated, high growth names like the Teslas in 2016, 17, and 18, when it was hard, when it was unpopular, when she was hated for doing it. And of course, now Cathie Wood comes across as the hero after markets are very, very green for a few years. But the real effort was made when nobody wanted to be on her side, and nobody wanted to buy during the red because people would rather, no, I'm gonna reevaluate my options. I'm just gonna sell. I'll just sell out of Virgin Galactic, not to mention any names. I'll just sell out of Virgin Galactic. I'll go reevaluate my opportunities because it's been a tough week. Anyway, Cathie Wood goes on to say that she discloses her holdings every day as an actively traded ETF because there are very few actively traded ETFs. She's right about this, and that's part of the rules of the game. But she does something special and also publishes her research. And by publishing her research, she actually believes, look, we put our research out there for criticism and commentary, and that is how we are able to sort through the FUD, the fear, uncertainty, and doubt. By seeing what society thinks, we can help adjust sort of our research and our formulas and our expectations for companies and see, okay, is there sort of a black hole in our research? So in a crazy way, by Cathie Wood putting her research out, she's actually improving the performance of her fund just by being open to commentary. Now, I have to say, it is weird, though, that their YouTube channel doesn't allow comments, but hey, we can still get insights from what it is that she says, and obviously Twitter is still available as an opportunity to interact with ARK Invest. But anyway, another issue that Cathie Wood talks about in her latest talk is how analysts are really stuck to comparing themselves to what the index funds are doing. What's the S&P 500 doing? As long as we can beat the S&P 500, we're good. Cathie Wood doesn't care about the indices. Cathie Wood isn't fighting to try to be right for a year or 18 months or 2 years. Her goal is 20 years from now to be able to look back and go, wow, look, we did invest where technology is right, where technology ended up happening. And we saw that coming and we invested at the early phase of the S-curve. And this is something that I thought was actually really powerful in the last discussion that she had, is she says, hey, look, here's the thing. When it comes to investing in transformative industries and you're investing in an early part of the S-curve, realize that once you see 10, 15%, 20% growth, that is when you are investing at the early part of the S-curve. And usually when we hear that, unless we're super familiar with it, it can be a little confusing. So why don't I just quickly pull up the iPad here and let's just draw what she means. So what Cathie Wood is talking about is when you invest early on and you start getting that 20% growth, that 10% growth, and you're starting to see that compounding growth, that could just be the beginning of what it will eventually be, this exponential growth and then this S-ing, right? So this is something that I've actually mentioned personally on this channel about Tesla before, is that I personally think Tesla is very early on this exponential growth curve, that growth is still ahead. And today, short of saying that about Tesla, Cathie essentially gave us this insight that the industry she's investing in right now, especially the EV market, she still thinks is early in the exponential curve. You know, we look at Tesla stock and we're like, come on, it went from, 2,000 to essentially, or 200 to 2,000, that's 10x, then split a 5x or divided by 5, right, in the stock split, and then went back to 900. Like, how could you not sell and take profits out of Tesla? Well, it's because why would you sell out of something that you were still so early in on the S-curve? We're just beginning the transformation, Cathie Wood says. This whole process of building wealth with these transformative companies, gosh, the transformation is just beginning. With this, Cathie Wood says, golly, how could you not invest in these transformative industries? Why would you go invest into companies that are dying, into companies who are not transforming and adapting? Why would you invest? And I'm filling these names in. She didn't mention these, right? But essentially, Cathie Wood is saying, why would you go invest into traditional, let's say, automakers like a Ford? Why would you invest into something like a movie theater? Why would you invest in retail? And this is her words, okay? Look, I'm all for diamond handing on AMC, but these are her opinions. Why would you invest in these potentially dying industries? She says, look, you think the retail, it can't get any worse for retail after going through what happened with COVID. She essentially laughs at that idea and says, you haven't even seen the start of it yet. And the fact that we've only transitioned to about 20% of sales online, sure, we 4x the amount of growth in online thanks to COVID, but the fact that we're still only 20% of sales being online has a whole lot of disruption ahead of it. She didn't mention names here, but obviously we can fill in. We know that is good for the Apple, the Etsy, the Wayfair, the Amazon. We know that's good for these platforms. She invests in Square. We know that's also good for Square, because what does Square do? It helps move businesses online with their omni-channel distribution network. Or not just their distribution network, but their distribution platform for getting channels to have the same inventory management system offline as they do online. So it becomes much easier to scale online and get retail online finally. Obviously, Shopify does a lot of this as well. Some who already have stores prefer Square and the transition for going from store to online or having both with Square. But either way, both great companies. Cathie Wood makes it very clear that if you're investing in ARK funds, you're getting innovation and transformation. You're not getting the stuff that might be sexy for a brief period of time, like, oh, yay, there's a rotation into value. You're getting something that will go through periods of, I don't want to invest in Tesla right now. It seems too overvalued. You're going to go through those periods. But you're investing something that in 10 years from now, you can look back and say, yeah, got in that S-curve early, just like Cathie said. I have to agree with everything she's outlined. Now, I don't necessarily agree with every single stock pick that Cathie Wood makes. It's one of the reasons I personally don't invest in ARK. But I could never say anything bad about what Cathie's doing, because what she's doing is exactly what I believe. I think it's great, and I'm not saying I'm copying her or she's copying me. We can all have our own opinion about this and pick different stocks and different allocations. Hey, you want to copy what Cathie Wood does with your own tweaks, or what I do with your own tweaks? Gee, go to like M1 Finance. Go to mettkevin.com/M1. Sign up for M1 Finance. You can make your own pie, your own sort of little mini ETF, if you will, and do it yourself. There's so many options for you to invest as sort of a pie or a portfolio of stocks yourself in an automated way. But what else does Cathie tell us? Well, she tells us, look, there is a lot of fear, uncertainty, and doubt regarding valuations right now. But when it comes to asking if we're in a bubble, Cathie Wood says absolutely not. She doesn't believe that we're in a bubble. She thinks bubbles are actually backwards looking, that all we're really doing is, or what some people are doing is they're saying, well, tech and EV must be in a bubble because the prices are so high. And look at the run-up we saw before the dot-com era. Well, that was a bubble, so why isn't this a bubble? She says this is the problem with looking backwards, is when you look backwards, all you see is a chart going up and assume that that means it must be a bubble. When Cathie Wood says, look, the dot-com era was early, 25 years too soon. But we are now in prime time. The plants, she says, are now flourishing. The plants that were planted then, the seeds then, are now flourishing. And that now is the time where we take technology into reality and into prime time of making tendies, basically. And we're at that S-curve phase of just beginning. And this is really, really good news for disruptive innovation. When Cathie talks about the Fed, she talks about how, look, we're going to see that CPI bump to 3 to 4%, that temporary base effect interest or inflation data that we've been talking about on this channel. We're going to see that, but it's going to be temporary. Now, what's interesting is Cathie Wood still maintains that she thinks there's a good chance the Federal Reserve could raise interest rates sooner than the Fed believes. But Cathie Wood believes that in the long term, we're not going to see hyperinflation. We're not going to see anything higher than maybe a 4% interest rate in the future. Even that, personally, I think is pretty high. I think the Fed's likely to stay around, a Fed discount rate of maybe 2.5%. We can differ there. But the reason she gives for inflation being temporary is fascinating. And she's talked about this before, but it's worth reiterating. It's worth noting that she believes there are two types of deflation. One is deflation that comes from technology. Hey, the easier it becomes to manufacture iPhones, the cheaper iPhones can become, and the better technology somebody can get in their hands for the same cost of dollars that they spend. $500 spent on an iPhone 10 years ago gets you way crappier technology than $500 spent on an iPhone today. That is a form of deflation. But there's also, and that's a good form of deflation because we get better stuff for less. But she also reiterates that there's a bad form of deflation, and that's when you get legacy companies like Ford having to cut prices in the future because they failed to innovate. They failed to keep up with the disruptive curves that we are seeing today. And she thinks there's going to be a lot of confusion. She thinks one of the reasons we see such low earnings multiples at some of the legacy companies, whether they're retail or companies that just aren't innovating, is because there's confusion. She thinks a lot of people look at a stock and say, oh, well, Tesla must be overvalued because the price to earnings ratio is so high. And, oh, another company must be a good deal because the price to earnings ratio is so low. And she says this is going to lead to a crisis, essentially. We're going to see bankruptcies at some of the original, the OG companies, potentially the Fords, the GM, the movie theaters, the retail. And all of these high valuations that we look at now, it's like, oh my gosh, 200, 300 PE ratio, that in the future might have a 50 times earnings multiple, but they'll actually be printing money because they are on the right side of change. Now, Cathie does briefly talk about how, in her opinion, stimulus passing is going to lead to higher taxes in either the form of higher inflation or future taxes, which is something that Joe Biden is potentially more likely to do, she says. But ultimately, she challenges investors. Are you on the right side of change? Are you on the right side of history? Now, what I want to do is just briefly pull up M1 Finance and just look at some of my more high conviction stocks. and see, are these, in my opinion, obviously I'm opining about my own choices here, on the right side of change? And so, for example, my top 10 are stocks like Etsy, Tesla, Enphase, EXPI, Peloton, Pinterest, Lemonade, Neo, Redfin, and CCIV Lucid. Personally, to me, none of these are legacy companies. None of these, in my opinion, are failing to innovate. Some of them might be trading at rich valuations, and even I personally, I bag on Peloton and Lemonade for being too expensive right now. I bag on Etsy for being too expensive when it's over $225. I get upset when Neo is in the $60 price range. It's obviously much cheaper right now. And this is where we have to look at what Kathy says and go, damn, all of those have just had a massive sell-off. That's an opportunity. We like to say crisis-opportunity is another option. When I do go out to, for example, my top 60 stocks, we get a little bit more of some of the legacy companies. I do put in, my Wayfair, my Shopify, Etsy, Pinterest, Lemonade, Shift Technology, Tattooed Chef, Chipotle. These are some great ones. I do have a couple legacy companies. For example, if I go to Safer Tech and Consumer, you can see these, by the way. Go to metkevin.com/1337, for example. Under Safer Tech and Consumer, I have some legacy companies. I've got maybe 5-6% in total allocated to stocks like Target, Lowe's, Home Depot, Walmart. But personally, I don't think those are the companies she's so worried about, disappearing. I think she's more referring to mostly the legacy automakers. I don't think she's very excited about those. But look, Kathy Wood does look at these sorts of stocks. She even looks at Apple and says, Apple might be a little bit more of a cash play. It's interesting. Maybe she's taking a little bit of a blunt point of view, but you have to say, when it comes to innovation, she is all in on the frontier of that. I'm skeptical of some of the choices, especially in bio, and maybe that's just me not being educated enough, so we'll do some more research there. We'll see how things develop. But look, if you need any motivation to say, hey, let's double down, let's be on the right side of change, and let's invest when things are cheap, just listen to Kathy. She posted her latest video, which you can watch. I obviously gave you a little synthesis or summary here along with my commentary. If you found this helpful, consider sharing it, and folks, we'll see you in the next one.